We check on oil prices, which have rebounded in Asian trade after easing overnight, as President Donald Trump said that the U.S. would pursue diplomacy with Iran rather than military action. Brent is up now about 0.7%, 84.30 a barrel. WTI slightly over $80. Now, expectations of more Russian oil shipments could add downward pressure on prices, with traders forecasting exports from Russia's western ports to rise 4% this month. And for more, we're joined by Samantha Dart, co-head of Global Commodities Research at Goldman Sachs. So, Samantha, we appreciate you making the time to join us on studio today. Just picking up on the moves we're seeing in oil prices. So they fell after signals that, the Strait of Hormuz could be reopening soon. But right now we're seeing them go back up in Asian trade. But it seems like we've been here before, the large swings as the conflict evolves. So how are you thinking about this volatility?
That's exactly right. And it's the headlines moving prices around, which is why at the end of the day, we have to work with scenarios, because in our view, what really matters are the flows, how much oil is making it to the global market. So in our base case, we assume a very gradual improvement of production from the Persian Gulf into early Q4. And under that assumption, we would expect Brent to average about $80 a barrel in Q4 and just about $70 a barrel next year. But it might not happen. So we have to consider those other alternatives. So, for example, if instead of this gradual normalization into early October, we have something that is a slower normalization over the course of next year, we could be talking about $120 over the course of Q4 and $100 on average next year. So it's really about the flows and what this does to global inventories of oil.
Well, there are other factors beyond geopolitics, including OPEC Plus, talking about another modest production increase. Nothing much revealed about the plans for Q4. How does this weigh into your outlook for the prices and the supply as well?
I think it's more symbolic than concrete, in the sense that a lot of that production requires passage through the strait to reach markets. So when we think about OPEC behavior in general, it is very much dictated by inventories, global inventories. Inventories are relatively low right now, so it makes sense that they see room to contribute with more production. But at the end of the day, we need the strait to be open for that to happen.
Yeah. Okay, and now you've also pointed out that the natural gas shock could actually be more damaging than the oil shock. Why is that? And if you could tell us, obviously, how significant that disruption to Qatari exports is as well in the grand scheme of things.
That's absolutely right. So there are two main reasons why the situation for gas is more critical than for oil. The first reason is that when you look at natural gas demand, it's very seasonal, and a lot of it is used for heating purposes in the winter in the Northern Hemisphere. So if you think of Europe, if you think of Northeast Asia, that's when demand really rises. So if we don't have that supply from the strait until then, we can see a much more significant increase in gas prices versus what we have seen so far. That's reason number one. Reason number two is how China has managed these markets, in the sense that for oil, China imports have been curtailed significantly during the war. They have now rebounded somewhat relative to June levels, but they are still down year on year. Not in natural gas. In natural gas, China imports were down in March and April, but since May, they've been going up and up and up, and now they are already in line with last year. So with China in the market, that means that for Europe to manage its storage levels, they need to compete with Asia via price. So that's how you can get higher and higher prices, and especially in the winter.
And another thing that we've been, I guess, not looking at as much is copper, but that has, quietly been rising despite the so-called easing in geopolitical tensions as we're seeing. What is supporting the price here? Is this also got to do with a genuine tightening in the physical market? And I want to know about the significance of China in this because it is a huge copper consumer. So is this a sign of stronger demand there in China, or what's the situation with copper?
Yeah, we see a couple of important drivers behind that support to copper prices. The first one, which has been playing out since last year, really, is policy driven. It's the fact that in the US, even though we don't have a US copper import tariff yet, there is a threat. There is this idea that we have one for aluminum, we have one for steel. We just had an executive order last month from President Trump talking about transparency of supply chains of critical materials. So when investors think that there might be an import tariff, they want to move the metal to the United States just in case, because then they can make up the difference in price. So this has resulted in a lot of supply of that metal just moving to the US, leaving the rest of the market a lot tighter. This is reason number one. But also the second driver that we have seen lies in China. And it's not really demand. If you look at end user demand in China, it's okay, but it's not extraordinarily strong. But what is happening is that scrap availability of copper, so the used metal that is resurfaced to be used again, that availability is a lot lower because there was VAT invoicing rules that have been tightened. So if that scrap availability is lower, there is a lot more buying of the regular copper that we see traded in the LME. So this has increased demand for the copper that we see in our screen. So it's this combination of a lot of metal having been moved to the US and China pulling more of it, not because of its demand, but because part of its used copper supply that we call scrap supply is just not there.
Okay, and Samantha, I'm going to just squeeze in one more question on gold because that's very important this year as well. We've seen it reach record highs. That's retreated. Goldman recently lowered its end-year target as well for prices. Where do you see it now? And we know the gold's very sensitive to real yields. So if the Fed is less predictable, less communicative, then what does this mean for gold?
So we still think that for gold, the main driver will be EM central bank buying. We think this is a structural support to gold prices, not just this year, but for the next couple of years at least, because we see these central banks looking to diversify their reserves into gold. And this is something that we think will help support gold prices just under $5,000 by the end of this year. So we have an end-year forecast of $4,900 a troy ounce.
Well, that's all we have today. Unfortunately, we appreciate you coming in, making time to talk to us. Samantha Dart there. She's co-head of Global Commodities Research at Goldman Sachs.